Welcome to Session 5. Today we'll examine what money costs a business. This session, Cost of Capital, focuses on understanding how to determine the cost of different sources of financing, including debt and equity, and calculating the weighted average cost of capital, WACC. This crucial concept is the foundation for making sound investment decisions, evaluating project profitability, and maximising shareholder wealth. By the end of this session, you'll have a solid grasp of how to calculate and interpret the cost of capital. The cost of capital represents the minimum rate of return that a company must earn on its investments to satisfy its investors, both debt holders and equity holders. It's the cost of using capital to finance investments, reflecting the opportunity cost of deploying those funds elsewhere. Understanding the cost of capital is essential for making sound investment decisions, as projects should only be pursued if they are expected to generate returns that exceed the cost of capital. The cost of debt represents the return that lenders require on the firm's debt, reflecting the riskiness of the debt and the prevailing interest rates in the market. It is typically measured by the yield to maturity, YTM, on the firm's bonds, which represents the total return that a bondholder will receive if they hold the bond until it matures. However, the cost of debt is adjusted for the tax deductibility of interest expense, as interest payments reduce the firm's taxable income. The formula for calculating the after-tax cost of debt is the after-tax cost of debt is equal to the yield to maturity, or YTM, multiplied by 1 minus the tax rate. After-tax cost of debt equals YTM times 1 minus tax rate. The cost of equity represents the return that equity investors require on their investment in the firm, reflecting the riskiness of the equity and the opportunity cost of investing elsewhere. Unlike the cost of debt, the cost of equity is more difficult to measure directly, as equity investors do not receive fixed payments like interest. Several methods can be used to estimate the cost of equity, including the capital asset pricing model, which relates a stock's expected return to its beta, a measure of its systematic risk. The weighted average cost of capital, WACC, represents the average cost of all the capital a company uses, including both debt and equity. It is calculated by weighting the cost of each source of capital by its proportion in the company's capital structure, reflecting the relative importance of each source of financing. The WACC is used as the discount rate in capital budgeting decisions, representing the minimum rate of return that a project must earn to be considered acceptable. That completes the introduction to this session. Thanks for your attention. Up next, in the workshop part of this session, we'll examine two key theoretical frameworks: Capital Asset Pricing Model, CAPM, a financial management application, and the Modigliani-Miller theorem,